Good morning, everybody, and welcome to the Elite Traders Club weekly analysis session for Monday, the 24th of August 2015. A very rocky week on the markets. Hopefully, you've all had a chance to watch the macroeconomic session that Jeff and I did on Friday. Really valuing Jeff's insights, in particular with his expertise in the all things fundamental in nature, concerned with the markets, and some really important views there. A lot of things happening in the world at the moment. We mentioned on Friday that we had things happening in China. We've got a new I think President or Prime Minister elect or Prime Minister perhaps going to be taking over Greece at some stage. We've got the Fed. Very undecided, not too sure whether they will be raising rates or not. Obviously the market's a degree of uncertainty at the moment. I've got a few notes here just coming through. Tried to watch the macroeconomic session, wouldn't play, kept coming out with error. I did try it on Sunday evening, and it did actually work on my computer. So look, I'll give it another go this morning, just to see whether or not it's fixed itself up. If it hasn't, certainly I'll look into it straight away and make sure that Kim's just said still not working. I did have a email conversation on Sunday, so I'll go and have a look at that. It probably just needs a particular box ticked on the YouTube link, so I'll certainly investigate that so you can all have a look. So that will make more sense what I've just been speaking about. All right, let's get underway. Quick reminder, really late notice, but if you do have time to come along to the Academy, starting off on Saturday morning, everyone's arriving on Friday. We still have a couple of places left, so certainly if a vacancy has made itself appear in your diary, please do come along. Certainly, as mentioned before, a really good team coming along, this particular year, and some really interesting topics that I think will benefit everybody, no matter what level of trader or an investor you are. So that's the Academy. The disclaimer: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, or your particular needs. So before making an investing decision based on the general advice presented in any of the following presentations, in fact, of the Elite Wealth presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, let's get underway. So the agenda today, obviously, portfolio management, what's been happening with our levels of risk in the market. We'll be having a look at some specific setups. I could only find 3 in total across both markets, so I'll be interested to see whether you found anything. Obviously, at this point in time, given where the market risk is, we're really more about looking after what we've already got in the portfolios, as opposed to adding positions at this point in time. Obviously, some Q&A at the end. Market risk. Well, the ASX 200, the benchmark index, is now in extreme risk. It was in extreme risk at the previous week, and it certainly feels like it at this point in time. The S&P 1500, our US benchmark, is now in a very high risk. We haven't been there for a little while, and again, it seems that whenever we get below 60 on our stochastics, and we'll go and have a look at this in a moment, that the propensity for the market to slip away does increase. Now, it doesn't mean that it's always going to do that, but certainly once we get down to those levels, if the market doesn't sort of stabilise, then the chances of a further deterioration start to increase. So I'll go and have a bit of a look at that as well. So whilst we are in extreme risk in the Australian market, it means that we have to apply a 10% market risk multiplier. In the US, being in very high risk, we need to apply a 20% market risk multiplier. And again, if you're unsure of what that means, you know what to do. Request a coaching call. All right, so in the Australian market, we are in extreme. Now, assuming that we have a 15% allowable drawdown and we are splitting our capital 50-50 between Australia and the US market, then that means that under an extreme risk condition, we use a market risk multiplier of 10%. We apply that to half of our allowable drawdown capital, which is 7.5%, and it means that we can have a total value at risk exposure of 0.75% on our ASX half of the portfolio, which at this point in time would be very good, having that little amount of capital exposed, given that the market's fallen away that amount. In the US, very high market risk condition there, so using a market risk multiplier of 20%, applying that 20% to our half of our 15%, so applying 20% to 7.5%, it means that we are allowed to have 1.5% value at risk exposed on the US side of things. Okay, those of you who are choosing to scale out, looking for one-to-one in the ASX because we are well and truly past high risk market, and the same in the US. Now, certainly in the past, we've talked about the benefits of choosing not to scale out, to trail your stops over a period of time, so that you create the chance for your trades to progress to their natural outcome. We've only been doing that for around about 3 or 4 months, and I think it's important, whilst the market is certainly in extreme and high risk territory at this point, that you think about the market conditions over the last 2 or 3 years, particularly those of you who are investing in the US, and the benefits of using those trailing stop methodologies. It means that some of the trades that you may well have been in over the last couple of years may well have progressed to become, really quite significant money spinners for you. And it's that as the backdrop that you need to think about, when market conditions change. So it's really all about, putting as much hay in the shed as you can whilst the times are good, so that when market conditions do eventually change, as they always will, that you've been able to really boost your portfolio. And naturally, whenever market conditions turn to the downside and we start to get into those very high and extreme risk levels, that you're always going to give some back. It's unavoidable. So it's something that you need to certainly put into a broader context. All right, so that's where we are in terms of market risk. Let's go now into Beyond Charts and have a little bit of a look at some of the indices, etc. So the first one we'll have a look at the local market first. The ASX 200 here, just highlighting on our stochastics there with the circle you can see, when we dipped below 60. So in many instances, once we get down to this particular high risk type of level, the market can go sideways. It can even start to move back up a little bit. What you tend to find, if you go back over a significant period of time, that if the market doesn't start to move back in a more meaningful strengthening way, that there is the chance that the market can slip away very, very quickly. And so we've been down below 60 for quite a period of time now, and the market has really just sort of drifted sideways, and really over the last couple of weeks has really fallen to the wayside quite significantly. The market now, from the beginning of the year, at this point, we're down about 4% from when we first started, after putting on around about 10% at the beginning of the year. So we've certainly come off the highs by a long, long way. In the US market, very interesting that, we talked about being in this sideways channel, if you wanted to call that a sideways ranging market. And interestingly that whilst being in that more recently, that we've had this deterioration in the stochastic. We've moved below 60, and whilst we were below 60, we're still within this trading range. And again, I mentioned on Friday that we had just on Thursday evening, we just closed outside the box type of formation that we've developed over the last about 6 months, and actually said on Friday that typically once we move out of the box, we get a move the width of the box, and it pretty much happened on Friday night, and we've got a candle that's closed all the way down here on its lows. So I just mentioned that in the macroeconomics session analysis session there. It has happened at this particular point. Really ugly candle. Big bearish Marubozu, no wick on the top, none on the bottom, looking really, really ugly. and as a result, there was quite a number of stop outs in the watch lists. Other than those two markets, I thought we'd just go through and just have a bit of a look at some of the other indices out there. QQQ, which is part of the Elite Funds Maximiser, really being belted at this point in time. It seems that there's not too many sectors that aren't experiencing a huge amount of supply at this point in time. Even the next one, XHB, which had been performing really, really strongly. Beautiful white candles over the previous week, really coming off very, very hard over the course of the weekend as well. Certainly still holding up a lot better than the broader market. So, the whole concept of relative strength. The Dow looking pretty terrible as well. At the moment, it's down, getting close to 8% for the year. And those last three candles just looking absolutely atrocious. Real capitulation at the moment. It would be nice to be seeing some sort of a bounce during the course of this particular week. Again, just thinking about your typical falling out of areas of where there has previously been support. I'd like to see at least some movement back up towards those areas and testing those, and just being mindful what might happen at those particular points as well. So that's the Dow. That's the Nasdaq, which at this point is pretty much about break even for the year. That's the big Nasdaq composite. That's got around about 2,700 individual stocks in it. That's the S&P 1500 again. The Japanese market at this point still up a little over 11%. So it has been performing, pretty well. They've still obviously got a degree of quantitative easing occurring and supporting their particular market. This is the Chinese index, and you can see that from early in the year, really outperforming, and then it really hit the shakes. And since then, it's just been, in terms of volatility, it's just been up and down like anything, and certainly a lot of the fear and the backdrop there sort of spreading to some other markets as well. The German market at this point in time up marginally. Certainly European markets coming off a bit the last few weeks. There we've got the French market by comparison, and that's the Italian market as well. So a bit of a look around global markets. Certainly every market's sort of in the last couple of weeks starting to feel a bit of the brunt of some of the uncertainty out there at this point in time. All right, let's go and have a look at some of the only setup I could actually find in the Australian market was HFA. HFA Holdings, and again, the relative strength on this particular one is quite evident there. And so from that point of view, we really just need to have a look at our price action. As a result, having a look at the last trough here, where is our last trough? And interestingly, that last candle, quite a reasonable white candle given what the rest of the market experienced last week. So that last bar on the relative strength comparative, certainly much higher than the second last bar there, such as the relative strength of this particular stock. That last trough, is it at or above the second from last medium-term peak? So let's just go through. And again, because I've got my annotation in the way that it's a little bit hard to see, but the low there is $2.20. The high of that medium-term peak there is $2.19. So that last trough is certainly above that second from last peak. So it meets our very stringent price action filter. As such, we just need to break through our last medium-term peak. Our last medium-term peak there was actually at $2.57, I think it was, which meant that we could go at $2.59. However, the last candle here, its high was at $2.58, so we need to go at least 2 pips above that. So instead of $2.59, we're having an entry price at $2.60. Where are we in the broader scheme of things? So if we sort of zoom out, we don't really sort of have anything major until we get past, up past these higher levels there. We do have a long-term trough, which is way back in 2007, so actually pre-GFC time. We sort of entered the GFC, round through these areas here, so it's really sort of dinosaur territory, although I'm sure there will still be people who remember the GFC, and hopefully they've done some education since then, and perhaps know what to do next time round when the markets put a spanner in the works. So we have an on-stop order for HFA at $2.60 with a limit to $2.62 and a protective stop at least 2 ATRs below that entry level, below that last medium term trough, and that comes in at $2.14. That's HFA. Some of the stop outs in the ASX last week, which we may as well have a bit of a look at whilst we are here. Two stocks in particular stopped out last week. One of those was IHK, which is the ETF which basically tracks the Hong Kong market. So I'll go and have a quick look at that one. And you'll see there in this particular situation that price closed below the trailing 3 ATR. Now, when we first got into this particular trade, our red line there was our initial 2 ATR based protective stop. It did come down about 5 or 6 weeks ago and penetrate or breach that initial soft stop. So that then got converted to a hard stop. And during the course of last week, whilst this did also close below its 3 ATR, remember the 3 ATR takes over once it passes our initial 2 ATR based stop. So during the course of last week, it did in fact trigger its hard stop. So remember the soft stop there previously being converted into a hard stop, and as a result, knocking us out of that trade last week. That was IHK. The other one that came out of the watch list was PME, which has only been in there for a couple of weeks. PME, pop that one in. Pro Medicus, pinging us in, 1, 2, 3, 4 weeks ago, and then since then coming down and actually closing down below our 3 ATR, coming up at the same time as our, it's exactly the same level as our initial stop. So at the same time they're choosing to close out on a close below that 3 ATR, given that it's at exactly the same level as the trailing or the initial 2 ATR. So that was PME. There was two that came out of the portfolio last week. There was one stock that got trailed. Does anyone know the stock in the Australian market that Stop actually trailed last week? Does anybody know? Yep, well done, Kay. Nailed it in one. Blackmores. Don't know whether those of you who are in Melbourne who get the Herald Sun, Jeff and I write an article in that every second week. We take it in turns, and I spoke about some of the things that we've discussed in our education sessions recently, and one of those was some of the stocks that over the last couple of years have risen in value in excess of 100%, and Blackmores was one of those. So was Capilano Honey, and even Qantas were stocks that have amongst around about, I think there's about 15 or 16 that had done so, and the article was really about creating the environment, i.e. following your trading plan that allows you a very simple way of, once you're in a trade, to capture as much of the move as you can. And this is one stock that has continued to move up despite the market, the broader market weakness. So yeah, the stock last week just coming up a few cents, around about 20 odd cents on BKL. So still performing very, very nicely. Let's go over to the US now and have a bit of a look at the two trades that I could find in that particular market. The first one is LLY, which is Eli Lilly and Co. Certainly last week's candle, it is white, so certainly closing higher than the previous week. A very long wick on the top, which is not surprising given what the broader market has done. As such, it did create a higher high and a higher low, and therefore put us into, again, a short-term uptrend, and at exactly the same time confirming the formation of a new medium-term trough. That trough, where is it in relation to the second from last medium-term peak? Well, it's clearly well above it. So from that point of view, all we need to do is make sure that we have a protective stop which is at least 2 ATRs from our entry level. Our entry level will be 2 pips above the high of our last medium term peak. Over here, the high there at $90.18. So our on-stop order is at $90.20 with a limit to $91.10. Protective stop at least 2 ATRs away and at least 0.5% below our last medium term trough. 2 ATRs in this particular example was just past $7. Yes, you're absolutely right, Darren. The setup would be a lot better if that last candle was upside down. Unfortunately, it's not. But absolutely, in terms of what it might look like, it would look certainly a lot better if that last candle was upside down. So protective stop, making sure that we are at least 2 ATRs away and at least 0.5% below that last medium-term trough. Let's just zoom out and see where we are. Again, any recent sort of history, we've got to go way back to 2000. That's when the dinosaurs roamed the earth. 2000. How many of you would have been investing in the US market way back in 2000? Certainly, there may be some people out there who still have the stock. Very unlikely at this particular point in time, given that they've gone through a GFC, and if they didn't get rid of it prior to then, and they're still hanging on to them, then there might be a little bit of supply there. But in terms of relative time frames, that's really ancient history. Certainly got a lot of work to do before breaching that particular level, but it does constitute a valid setup. The next one on the list, and this was the only other one that I could find, was PRE, and I don't particularly like the setup all that much, given that the recent volatility of this particular price action has been very shallow, but as such, it still does constitute a valid setup in terms of our price action filter. If we just sort of zoom out a little bit and have a look at its basic ebbs and flows in previous, whilst it's not a stock that moves significantly up and down, and you'll see lots of smaller upward movements and downward movements along the way. Of late, the price action has been very limited. I always get a little bit fearful about these sorts of setups, even though the ATR still, because the ATR, when you think about it, it's measuring average true range over a 21-week period, so it is encapsulating some of these slightly bigger moves, etc., and that's why our 2 ATR stop is down at 132.76. I'll just grab this annotation so you can see that on the chart there. So the last trough that's just formed, it only formed last week because we had a higher high and a higher low. Not that you can really tell by looking at that. If I put the value line on there just for comparative purposes, let's just move our annotation out of the way there. The high of last week's candle was 138.80. Previous high 138.68, so it was marginally higher than the previous week, and at the same time putting in a higher low as well. So we are back into short-term uptrend, and at the same time therefore confirming the formation of a new medium-term trough. That trough well clear of the second from last medium-term peak. And as such, we have an on-stop order at $139.46 with a limit to 1% above that level of 140.85 and a protective stop coming in at 132.76. They were the main ones that I could find in the scans that came up in the US. Some of the stop outs this week, and what I might do to make it a little bit easier is just to go through the current portfolio and have a look at the US weekly opens. And I think it's interesting to get a bit of a visual as to what's happening to those that are still in the watch list along the way. The AYI has been a stock that over the last 3 or 4 months has presented a number of opportunities to get in it, and hopefully those of you that were in it earlier on are still in it. It's continuing to move along very nicely, and certainly along the way, if you've found that you've made a significant degree of profit over that period of time, there's certainly nothing the matter with taking half off the table. The last time we had some price volume volatility signals were a little while ago, remembering that they are opportunities that should you be up sufficiently in the trade and you want to exercise some discretion and take some profit off the table, then by all means you can do that. Certainly not worth taking profit off the table if you're not making at least a minimum of 1-to-1. But needless to say, if your trade progresses along the way and you're continuing to rack up profits, then certainly at some point, if you feel the need to take some profits, then there's nothing the matter with doing that. But certainly the way to really boost your portfolio over the longer term is to continue to trail. And if another opportunity happens to come up along the way and you can add back in, then certainly feel free to do that as well. Nothing the matter with adding to a winning trade, particularly if in previous instances you've taken a little bit of profit off the table, the stock is showing good relative strength again, good solid price action, then by all means don't be frightened to get back into any of those trades. I've actually done that on a number of Aussie stocks in my portfolio where I've been up quite significant amounts in fairly short spaces of time, and I've had the odd price volume volatility signal go off, and therefore I've chosen to exercise that discretion and locking in at least half profits by selling half and just waiting to see whether the stock is going to set up another opportunity to enter. So the stocks that this week were stop outs, ANTM was a stop out this week. So I think it's important to go through and have a look at those stocks that have been stopped out. The 3 ATR coming up past our initial 2 ATR stop there, price closing below it, and therefore a market exit tonight on the open. That's ANTM. Other ones, AWH, Allied World Assurance, again just closing below its trailing 3 ATR. The stock, once it was triggered way back on the 14th of May, did move up reasonably strongly, dragged its trailing 3 ATR up. As a result this week, coming down, just closing below it. The fact that the trailing 3 ATR did come up above our initial protective stop, it just means that the loss on this particular trade is much smaller than what it may have normally been. Also important to discuss at this point in time, I think the use of soft stops versus hard stops. I'm a big advocate of using soft stops, particularly for your trailing methodology. Certainly the research and the evidence over many years is that over the longer term, using a soft stop is going to be better than using a physical hard stop. However, certainly understand that some people don't like using soft stops, and there's nothing the matter with using a trailing stop that uses a hard stop. And this week, a hard stop actually would have worked better for you on those trades where we got stopped out. So we'll go through and have a look at what that actually means. So the next one that came out of the watch list, CBPO, was one that came out. Again, in this particular example, our trailing 3 ATR coming up above our initial 2 ATR. And you'll see through here that during the course of the history of this trade, it actually came down a couple of times and breached what was our trailing 3 ATR. Now, at that particular point in time, if you used a hard trailing stop, you would have been triggered out at those particular points. Price has now moved in the opposite direction, 3 ATRs effectively, and is now closed below our trailing 3 ATR. So now we're getting out at a worse price than if we had have used a hard stop. It swings and roundabouts, and I know that if you go over and have a look at many trades that have been not just in the watch list but of your own as well, that you'll get similar experiences along the way. So that was one that came out. ENDP, Endo International. Again, this one had been in the portfolio for a period of time. It was one that we've taken over that was pre-existing in there, and eventually, the trailing 3 ATR had come up. The last few months had come back basically pretty much smack bang on 3 ATRs to our level. It did start to move up away again, and this is the benefit of using a soft stop for your 3 ATR, and with broader market strength, there's a fairly significant chance that this would start moving back up towards its previous highs. Unfortunately, market weakness of recent times has meant that prices fallen by the wayside again, and we're getting out this time now at around the 76.61 level as opposed to 79.67 if you were using a hard stop. So I think, again, it's just important to acknowledge that sometimes using a hard stop is going to be beneficial to your end result. In other times, it's not. You just need to be comfortable whichever method you're using and just be consistent in its application. Goldman Sachs was another one that was exited this particular week and coming back a fair way below its trailing 3 ATR protective stop. In actual fact, coming back to the initial 2 ATR, you see the red line there that was the initial stop on the setup for Goldman Sachs. So coming back a fair way on that one, Goldman Sachs. The other ones, HQL was one. HQL, I'll bring that one up there, and again coming down a fair way as well. So what was a profitable trade is just going to turn slightly negative on the basis of how far it's moved down below its trailing 3 ATR at this time. The other ones in there, I won't go through them all. IBKR, which was Interactive Brokers, IWO, which was the iShares Russell, I think it is, MHFI, which was McGraw-Hill Financial, MS, which was a stock chart that was looking very similar to, I think it was Interactive Brokers. It had been performing reasonably well. Big dirty black candle. And again, instead of being out at a hard stop at 36.24, we're exiting at 34.21. That's on Morgan Stanley. A couple of questions there. One from Paul Brisbane. Given the falls in QQQ and XHB, do you think we should apply a hard stop to these stocks tonight? Really good question. I understand completely where that's coming from. Those two ETFs are part of the Elite Funds Maximizer strategy, and all the whole systemized approach, etc., is to remain in those stocks until the end of the respective months, and the results of that particular strategy have been achieved on exactly the same system, exactly the same methodology, in that we stay in the trade until the end of the month, we run the scans again, and we rinse and repeat. That's basically the process. What you'll find is that at any particular point when the market turns, if it turns quickly, they're always going to be exposed to a certain degree of downside. What is happening in the background while this market movement's going on? There will be other sectors, there will be other ETFs. They may not necessarily be financial market sectors. What I mean by that, stock indice sectors. They might be commodity based, they might be volatility based, etc., that start to improve whilst your stock based ETFs are starting to move in counter directions. So hopefully that makes sense there for you, Paul. PME John, can you clarify what you said earlier re hitting hard stop set last week's session? Last week's comment was to convert hard stop at 199. Doubt that many would be able to do that due to low liquidity. Okay, so I'll go back to PME. In this particular example here, we had PME, we had the trailing stop and also the 3 ATR stop at the same particular levels there. Last week we did have a breach of the initial 2 ATR stop. So from that point of view, in the watch list there, the low there, it was $2. So putting a protective stop, converting that what was a soft stop into a hard stop. So the rule there is to take 0.5% off the low of that candle. So 0.5% off of $2 is 1 cent. So that puts a hard stop at $1.99. So depending on the liquidity, etc., if we go through and then have a look at this on a daily basis, When did the stock price hit $1.99? So during the course of the week, we had a close there of 213, a low of 210. The following day, a low of 204. The following day, a low of 205, and then on the Friday, throughout the course of the day, we had a low of $1.97, price fluctuating between 206, there the high, and the low of $1.97. So during the course of that day, depending on liquidity, depending on how many shares up for purchase and sale at that particular time, is going to obviously depend on whether you're able to get out at exactly that particular level. But good question, Kim. I know you're an advocate getting out of stocks at market when closed below 380 occurs. What's wrong with setting hard stop 0.5% below the low of the candle for a second chance if the markets turn, especially considering latest candles closed on their low anyway? Not much to lose, but lots to gain. Yeah, look, certainly you could do that if you wanted to, Kim. What Kim's suggesting, we go back and have a look at. Let's go and have a look at our portfolio and pick out one as an example. So here on Morgan Stanley, we've got our trailing 3 ATR, and once price closes below, then what Kim is suggesting, well, why not put in a hard stop, perhaps 0.5% below the low of the candle that has closed below, and that way, if the market does happen to rally and move higher, then certainly, look, you could do that. There's nothing the matter with doing that. The only problem is that even though you might put a hard stop in there, there's still the chance that we might get a gap down tonight, and you might find that you're another $3 or $4 down with the markets moving the way they are at this point in time. So with this, this sort of thing, I'm comfortable just exiting at market. Again, simplicity is what we want to be thinking about, and I think the more variables you introduce, the more excuses you give to yourself to tinker with what is, over the longer term, a really good strategy for helping you to capture those trades that are really going to boost your portfolio. We never know when the market's going to turn like this. When it turns, how quickly it's going to turn. Certainly, if you are of the right mindset, and you know yourself well enough, then it's all about being consistent. A lot of developing traders, investors, particularly at these times when the market is very volatile and we get these sorts of changes, panic comes in, and there is a real tendency for investors, even though they've learnt some really good methodologies and some good skill sets, and hopefully improve their mindset, which is a huge component of the way they invest and look at the markets, particularly in these sorts of environments, can come a bit unstuck if they're not 100% on exactly what they want to do. But good questions, and I think it's really worth throwing up some ideas to constantly challenge yourself and test your own thinking about the markets, but certainly from a trade management, from a portfolio management point of view, from a individual development point of view, I'm really of the belief that you want to keep things as simple as possible and not tinker once you've got a methodology that you're comfortable with, because otherwise you're just going to spend a lot of time looking for ways to try and reinvent things, and it's time that's wasted, because all it does, it starts to unpick your very strong mental capacities that you've developed over a period of time. Okay, so a couple of other things I just wanted to draw to your attention this week. I just had a couple of notes just to reiterate. I ran a couple of education sessions about 3 or 4 weeks ago about, and I just alluded to it earlier in the webinar, about stocks that had profited nicely over the last couple of years. Certainly during this particular time, I get a feel that a lot of people at this point in time are probably a bit anxious about their portfolios, etc. Bear in mind that over the course of the last few months, there have been a number of stop outs in the portfolio, which is natural when markets are starting to weaken and potentially roll over. Now, when they do roll over, as our market, our indicators, etc., And if I just moved back to a couple of those, just to give it a bit of a context again, if we go back to our portfolio benchmarks, go back up to the top, so we've got them both together. You can see as I'm going through these particular markets that no market has been untouched, that whilst our market risk indicators have been deteriorating, these are signals for us as investors to be managing our portfolios, to be reducing exposure, and hence using our market risk multipliers, so that when and if the markets do happen to be rolling over, that they don't take a whole stack of cash with them. The important backdrop to that is that at the same time, when markets have been moving in an upward type of direction, that we're looking to manage our portfolios in a way that allows us to capture some of those bigger moving trades. Now, the Australian market has been quite a difficult market to be in over the last 3 or 4 years, and you've only got to look at the price action, that really the market has really just sort of gone sideways for a long period of time, and that makes it very difficult when we're experiencing those sorts of, ranging sort of markets. It makes it difficult for the mums and dads out there to really know where to look for. The beauty of your scans that you've got in Beyond Charts is that it helps to find those stocks that have the much bigger, much greater, much higher relative strength. So against this market backdrop, your scans are helping to point you into those sectors and those particular stocks that are performing better than the broader benchmark. Your job then, once you've identified them, is really just to monitor them in a very simplified trade management way. And if you can do that with this as your backdrop, and you're fortunate enough along the way to have some stocks that move quite significantly, then that's going to make up for the times when the market starts to roll over and do this. Now, certainly those of you that are trading both the Australian market and the US market will be able to compare the performance of your two portfolios. And I know a lot of you out there are trading just solely the US as an example. And speaking with a number of clients recently, some of the results that you guys are getting from the US portfolio, I've spoken to 3 clients in the last week, that despite what had happened up until midway through last week, their portfolios were up over 20%, which is obviously a massive outperformance. Not underestimating the impact of currency fluctuations and those sorts of things as well, but from just a management point of view, if you go back over a number of years, as an example, we just talked about the ASX 200. We know that this year in the American market that it's really been sideways. Our market got off to a quick start. Their market just sort of went up a little bit and continued to go sideways. If we just sort of zoom out and have a bit of a look at what this market has done over recent time frame, it's a market that has certainly been far more directional, not without its volatility certainly, which the Australian market seems to have quite a lot of, but it's certainly been a market that has primarily just been in one long, massive upward move. And to really highlight that, if you have a look at this on a monthly, ignore the stochastic down the bottom because that's doing all its calculations on a daily basis, and all these market risks on a daily basis. But this is one massive long bull market, and a really nice bull market, bear market indicator is your 200-day period moving average. And this is just a little bit of background for you, which on a monthly basis equates to around about 10 months. So what I'm going to do here is I'm just going to put on a 10-month moving average, just a 10-month EMA. You can apply a 40 to a weekly one if you like. And what this does very, very nicely is over a period of time, let's go back to your GFC times as an example. And very simple, when prices are closing below your 10-month moving average, we're in bear market territory. And you'll see that even during the GFC, we had closes back in 2008. Did we ever close back above our 10-month moving average? Well, let's have a bit of a look. The close there is 318.49. The close of our 10-month is 318.52. We are below. We stayed below it for a long, long time. We didn't, in fact, come out of bear market territory until July of 2009, and we stayed above it for many, many months until eventually we closed below it. We closed above it, we closed below it, we closed above it. So market timing is never 100%. There's always going to be a transitionary period. But since then, we closed above it from September 2010, and then we closed in August 2011. So nearly 12 months there. Since then, when did prices close back above that particular level? We had a close there of 289.31, so a close above it. The following one, 287.96, a close above it. 290, we had a close above it. Did we have a close below it? 302, and it's 304. So from 2012 all the way through to now, we've got to wait until the end of the month to see what's going to happen with the market in the US. But since that time, we've been in one long bull market. So with that as the backdrop, there's been plenty of opportunity to find stocks, to manage them, create the environment in which they can do what they need to do, to put hay in the shed. Now, when the market does correct and we do get a close below here, then obviously we're firmly in bear market territory. At this point in time, I'd say we are probably going to close below there, and that's the end of a magnificent run. Again, that's a very simplified approach, but the metrics that you use, they don't need to be complicated and difficult. You can go back in time all the way back to, if you want to, you can go all the way back to, using the Dow as an example, and go back to the 1900s and have a look at exactly the same sort of concept. So there are certainly clearly evident times when you need to be in the market, and there are clearly times when you need to be out of the market. But unfortunately, they're not black and white as the candles are on the chart. Markets tend to take a little while to transition, and then they'll turn around and go the other way until eventually things start to settle out again, and the market regroups and starts to move onwards and upwards again. It's a different sort of metric, but nonetheless still quite simple and quite an effective model as well. Right, folks, are there any questions out there? We've had some good ones this morning. Certainly understand at this point in time if you're feeling a little bit shell-shocked as to what's happened over the last week. Certainly it's going to be pretty ugly on the markets today, I would think, given what's happened over the course of the weekend. Darren says, not surprised to see a correction in the US market. Price going up faster than time. Time needs to catch up. It probably does, yeah. Prices have risen very quickly over a short period of time. There's been lots of money printing. It's got to find a home. Where's the best home for that market? Where can it do get the greatest returns? And that's been in particular in the US market over the last few years. Mark has asked about short trades. Well, the medium-term strategy, weekly based, is a long-only strategy. Certainly we've got the Academy coming up this particular weekend, and I'll be having some discussions with some of the others in the team as to whether or not we think it's appropriate to be doing any short trades at this point in time. I'm not a big advocate of short trades until we are firmly in bear market territory at this point in time. And again, some of the biggest rallies you'll ever get are when you're in bear markets, and so going short prematurely when markets are just starting to roll over can be an extremely high-risk strategy, and it's not something that I want to introduce to a philosophy which is really long only. At this point in time, if you've been knocked out of trades, then there's a reason for that. And so now it becomes a matter of protection of capital. It's the number one concept when you're thinking about your investing. Protection of capital is absolutely paramount, because if we find that this market does roll over and drops 10%, 20%, whatever it may be, then you're going to look back in 3 or 4 months' time and think, oh, geez, I'm glad I'm out of that particular market. So that's what it's about. Preserve your capital, and keep your powder dry. We don't need to be in the market all the time. And in fact, being out of the market is a position in itself. But good question. Good question. Any others? Not at this point in time. All right. Well, what I will do is I'll go through and check up on the macroeconomics analysis session and make sure that that's all running. And as soon as I do that, that will be available for viewing. So I'm hoping that should be up and available for you to view in probably about the next 5 or 10 minutes. All right, folks. Well, thanks for tuning in today. I will have an education session this Wednesday afternoon. Next Monday's session, I will be at the Academy, so it's likely to be a recorded session. I am running a couple of sessions on Saturday afternoon, and the participants who come along to that session will actually be helping me with the watch list. Running a session on trade management, trade entries, all sorts of different rules and things like that. So I'll certainly be looking forward to their assistance on what is normally a pretty lonely sort of task. Those of you who are coming to the Academy, look forward to catching up with you and meeting a few of you in person for the first time. Some of you might be the second or third time, so that's fantastic. And also excited to be able to introduce you to a few new traders as well. So looking forward to that, and we'll catch up with you on the Friday, those of you who are attending. The macroeconomics analysis session for the Friday, Jeff and I, if we can find some time, we'll try and do a pre-record on that Friday afternoon and have that posted as well. But until then, keep an eye on the markets, continue to manage your trades in the appropriate way, and we'll catch up with you again live on Wednesday afternoon for the weekly education session. Bye for now.